Good day, fellow investors. Value Investing Quadrant update. We have a few stocks that are a buy, and let's discuss the update for this month. So for those who don't know, this is the Value Investing Quadrant developed by me, Sven Karlin, where the goal is value investing is to find low risk and high reward investments, contrary to market theory where only high risk leads to high reward. So we are looking for investments on this side of the quadrant, and over the last few months we have really analyzed a lot of stocks, and it's time to update this. And before we start, I want to discuss the definition of risk in this quadrant. There are two factors that impact risk: the price paid and the business risk. For example, Berkshire has absolutely no business risk. Berkshire is a financial fortress, is a hedge structured to really survive whatever comes in any form over the future, and therefore there is no risk. However, I have not put it here higher on the risk axis because when you look at Berkshire's stock price, it is a little bit pricey. So Berkshire historically used to trade at a price earnings ratio between 10 and 20. 10 closer to insurance price earnings ratios and 20 closer to, let's say, the average over the last 15-20 years. However, in 2020, the P ratio was just 10. Earnings grew, but now the P ratio of Berkshire is around 25, something like that. So that is on the higher side of the Berkshire actual P ratio, and therefore that is the risk with Berkshire. So no business risk, just price risk. And those two components is something we have to watch with every business opportunity. So let's start discussing and updating the quadrant here. First, I have to update Google. We'll discuss a little bit more there, but given the situation and where Google is, I have to put it as more risky because of the surge business disruption coming, and therefore also if the revenues slow down, I have to put it at a lower, let's say, return. So that is the value investment quadrant. Slower growth, higher risk. I will put it somewhere here, let's say 8% for Google, if not lower. We will update with a full video in 2 days. For the rest, retail is also cheap, but maybe a little bit riskier than the market because of the competition, because of change in consumer behavior. Everything is a little bit blended there. So I must say I don't understand retail enough for it to be a lower risk perception here. And that's perhaps the third component of risk. If you don't understand something enough, that's hugely risky. For the rest, everything here on the market extremely risky because of price. Of course, the S&P 500 cannot go bankrupt. Berkshire is much better than the S&P 500 now. Very expensive companies remain very expensive, very low reward, very high risk, mid-market somewhere. And then we go to the buy side. And I would say that Berkshire could be a little bit higher here, but it is the price. If you can buy Berkshire and then buy more if it goes lower, if you're looking for a long-term investment, then this definitely is a buy. We have food here that those are cheap on the cycle, can get a little bit cheaper, but on the cash flows we are close to 10% returns from Archer Daniel and Nutrien. All the links to all the videos here will be in the description of this video below, so if you want to check a specific stock, just check the description below. And here I want to add Rubis today. That is a stock that we already discussed here on the YouTube channel, but it is a very interesting play as the stock price went down. Thus, it is now a good buy. And I want to also share something from my research platform. Don't forget, there is a 21-day money-back guarantee, so you can check everything I do. You can check my portfolios and then make an informed decision on whether my research platform focused on value investing is for you. Here is Rubis. The stock boomed on some French investors buying it, doing well, and now it just reverted to where it was 10 months ago. But I think still the same company. If I look at the P ratio is below 10, the dividend yield is high, and let's dig into the business. Rubis, they provide fuel, energy, bitumen for asphalt, and they operate in strange countries, we could say. The Caribbean, Africa, but guess what? People drive cars there too. People build roads there too. And they have energy renewable business in France. The guidance was a little bit revised as oil prices dropped, but still okay. Adjusting for the net capital gain, we are around 250 million euros in net income. A lot of that goes for the dividend, but 250 million compared to the market cap, we are still at a free cash flow yield of a little bit more than 10%. That goes into the dividend yield, which is not bad. Keep in mind French taxes on dividends that are something. The business stable, volumes up, which is something always I check whenever I look at commodity businesses. I look at volumes. That means they are growing, and as the price of oil goes up and down, they will make more money because their volumes are growing. A little bit of margin contraction, a little bit down, some issues in Kenya, some issues there, but all in all a stable business, and they are just distributing there in Africa and the Caribbean, and nothing wrong with that. They are also a producer of renewable energy, which I consider a bonus. It's not yet that interesting from a cash flow perspective, even if they are growing it, but they plan to grow it 5 times secured portfolio, and perhaps if they grow it 5 times, they will get to 5.2 gigawatts of production. And recently, I think Brookfield paid for 8.4, paid 6 billion. So if they grow it, maybe they will get 3 billion if Brookfield is still around. So when it comes to Rubis, I have put it here, likely a 10% return. We still have to dig into oil. Perhaps it can go lower if oil prices go lower, and therefore a very interesting play. So for now, we have 4 buys here that we cover on YouTube and follow. There is always my research platform that I think has better buys. As said, you can check it out for an informed decision. And many of you asked why Brookfield, for example, isn't on the value investment quadrant. Because when it comes to bets, to clear pure bets, I know Nike is going to be around over 10 years. I know other businesses are going to be around. And Brookfield offers on one side 20% per year, but if the environment changes, it goes to 0. So maybe I should put it as high risk, extreme risk, 20% per year returns, but value investing quadrant, and Brookfield is not value investing. That's just the name of the game. I wish all Brookfield investors good luck, but I'll put also my discussion on Brookfield in the link in the description below. So I hope you enjoy the quadrant. Subscribe for more. Check the links in the description below. You can also subscribe to the Value Investing Quadrant newsletter to just get once a month the update in your inbox. See you in the next video.